Today, we shall be talking about mastering index funds, your ultimate guide to smart investing. Welcome back to the Business Investment Vault, your trusted source for insightful investment strategies. Today, we're diving deep into the world of index funds, a topic that's both timely and essential for investors at all levels. Index funds have gained immense popularity due to their simplicity, cost-effectiveness, and impressive performance over time. But what exactly are they? How do they work? And why investing legends like Warren Buffett swear by them? Stick around because you don't want to miss this. And hey, if you haven't already, make sure to like, subscribe, and hit that notification bell so you never miss out on our insightful content, and how they can fit into your investment portfolio. Let's explore. An index fund is a type of mutual fund or exchange-traded fund, ETF, designed to replicate the performance of a specific market index, such as the S&P 500. By holding a diversified portfolio that mirrors the components of the chosen index, these funds aim to match its returns. The S&P 500, for instance, includes 500 of the largest US companies, offering investors exposure to a broad segment of the market. Imagine owning a little piece of some of the biggest companies in the world, Apple, Microsoft, Amazon, all in one single investment. Sounds good, right? That's the power of an index fund. Renowned investor Warren Buffett has long advocated for index funds. In his 2016 letter to shareholders, he emphasized that low-cost index funds are the smartest investment most people can make. He stated, "When trillions of dollars are managed by Wall Streeters charging high fees, it will usually be the managers who reap outsized profits, not the clients." One of the primary advantages of index funds is their low management fees. Since they are passively managed, simply tracking an index, they incur fewer costs compared to actively managed funds, where managers make frequent trades in an attempt to outperform the market. These lower fees can significantly enhance your returns over time, especially when compounded over decades. Diversification and risk management. Investing in an index fund provides instant diversification. By holding a single fund, you're essentially investing in all the companies that make up that index. This broad exposure helps mitigate risk, as the performance isn't tied to a single company or sector. Historically, major indices like the S&P 500 have delivered solid returns over the long term, making index funds a compelling choice for those seeking steady growth. Now let's talk about its potential drawbacks. However, it's important to be aware of potential drawbacks. Since index funds aim to match the market, they don't have the flexibility to adjust holdings in response to market downturns. This means that during periods of decline, index funds will mirror the market's losses. Additionally, because they hold a broad range of companies, the underperformance of certain sectors can impact overall returns. Getting started with index funds. If you're considering adding index funds to your portfolio, here's how to get started. 1. Choose an index. Decide which market index aligns with your investment goals. Common choices include the S&P 500 for large-cap US stocks or the total stock market index for broader exposure. 2. Select a fund. Research funds that track your chosen index. Look for those with low expense ratios and reputable management. 3. Open an account. You'll need a brokerage account to purchase index funds. Many online brokers offer user-friendly platforms with minimal fees. 4. Invest regularly. Consider setting up automatic contributions to take advantage of dollar cost averaging, which can help reduce the impact of market volatility. Let's take a look at some of the most popular index funds and what makes them special. Platforms like Fidelity, Vanguard, and Charles Schwab offer a variety of index funds with competitive expense ratios. Fidelity, no account minimum, and it's great for beginners. Vanguard, known for its low expense ratios and long history of success. Charles Schwab, excellent for investors looking for fractional shares and automated investing. Each provider has its perks, so it's all about what fits your investing style best. Kindly subscribe to our YouTube channel, and don't forget to turn on the notification bell, as we shall be dwelling on the major differences between Fidelity, Vanguard, and Charles Schwab in our next video. Having done that, let's dive further. The power of patience. According to Investopedia, investing in index funds is a long-term strategy. The market will have its ups and downs, but maintaining a patient, disciplined approach is key. As highlighted in a recent article, the power of patience and focusing on long-term investing over short-term market moves is crucial. By staying the course and allowing your investments to grow over time, you harness the power of compounding returns. Now let's talk about tax forms and a calculator. Another advantage of index funds is their tax efficiency. Due to their passive management style, they typically generate fewer taxable events compared to actively managed funds. This can result in lower capital gains taxes for investors. However, it's always wise to consult with a tax professional to understand how these factors impact your individual situation. Let's address some common misconceptions about index funds. Myth 1: index funds are only for beginners. The fact is, investors of all experience levels use index funds due to their cost-effectiveness and diversification benefits. Myth 2: you can't lose money with index funds. While index funds are often considered safer than individual stocks due to their diversification, it's a misconception that they are risk-free. Index funds track the performance of a specific market index, such as the S&P 500. If the overall market declines, the value of your index fund will also decrease. For instance, during market downturns, like the one highlighted in a recent MarketWatch article, the S&P 500 experienced significant drops, underscoring the inherent risks in market investments. It's essential to understand that all investments carry some level of risk, and past performance does not guarantee future results. Diversification can help mitigate risks, but it doesn't eliminate them entirely. Always assess your risk tolerance and investment horizon when considering index funds. Myth 3: all index funds are the same. Not all index funds are created equal. They can track different indexes, have varying expense ratios, and employ different strategies. Some may focus on large cap stocks, while others might target small cap or international markets. Additionally, the method of weighting can differ. For example, traditional index funds are market cap weighted, meaning companies with larger market capitalizations have a more significant impact on the fund's performance. In contrast, equal weighted index funds assign the same weight to each company, offering a different risk and return profile. It's crucial to research and choose an index fund that aligns with your investment goals and risk tolerance. Pay attention to factors like the fund's expense ratio, the index it tracks, and its historical performance. Myth 4: index funds always outperform actively managed funds. While index funds have historically outperformed many actively managed funds, especially over the long term, this is not always the case. There are periods when actively managed funds may outperform the market, particularly in less efficient markets or during times of market volatility. However, identifying these periods in advance is challenging, and actively managed funds often come with higher fees, which can erode returns over time. It's essential to weigh the potential for higher returns against the increased costs and risks associated with actively managed funds. A diversified portfolio that includes both index funds and actively managed funds may be appropriate for some investors. Myth 5: you need a lot of money to invest in index funds. Contrary to this belief, many index funds have low minimum investment requirements, making them accessible to a broad range of investors. Some brokerage firms offer index funds with no minimum investment at all. Additionally, investing in index-based ETFs, exchange-traded funds, allows you to purchase shares at the current market price, which can be relatively low, depending on the ETF. Starting with small, regular contributions can be an effective way to build your investment over time through a strategy known as dollar cost averaging. This approach can help reduce the impact of market volatility on your investment. Myth 6: index funds are only for retirement accounts. While index funds are a popular choice for retirement accounts due to their long-term growth potential and low fees, they are not limited to these accounts. Investors can purchase index funds in various types of investment accounts, including taxable brokerage accounts, education savings accounts, and more. Their flexibility and broad market exposure make them suitable for a variety of investment objectives beyond retirement planning. Consider your individual financial goals and time horizon when deciding where to include index funds in your investment strategy. Advanced strategies for investing in index funds. Please, kindly encourage us by liking, subscribing and comment on this post. This will help us expand our research scope. Now that we've debunked some common myths, let's explore advanced strategies to optimize your index fund investments. Remember, these strategies may not be suitable for everyone, so it's important to consult with a financial advisor to determine the best approach for your individual situation. 1. Factor investing. Factor investing involves targeting specific drivers of returns within an index fund. Common factors include value, momentum, quality, and size. By focusing on these factors, investors aim to achieve higher returns or reduce risk compared to traditional market cap-weighted index funds. For example, a value-focused index fund invests in companies that appear undervalued based on financial metrics, while a momentum-focused fund invests in companies with strong recent performance. It's important to note that factor investing can lead to periods of underperformance compared to the broader market, so a long-term investment horizon and discipline are crucial. 2. Tax loss harvesting. Tax loss harvesting is a strategy where investors sell securities at a loss to offset capital gains taxes. This can be particularly effective with index funds, as you can sell a fund that has declined in value and replace it with a similar, but not identical, fund to maintain market exposure. This strategy helps reduce your tax liability while keeping your investment strategy on track. Be mindful of the wash sale rule, which prohibits buying the same or a substantially identical security within 30 days of the sale, as this would disallow the tax loss. 3. Core satellite approach. In the core satellite approach, the core of your portfolio consists of broad-based index funds that provide market exposure and stability. The satellites are smaller allocations to investments that aim to outperform the market, such as actively managed funds, sector-specific ETFs, or individual stocks. This strategy combines the benefits of passive investing with the potential for higher returns through active management. This approach allows for diversification and the opportunity to capitalize on specific investment opportunities while keeping costs relatively low. 4. International diversification. While domestic index funds provide exposure to the US market, international index funds offer access to global markets, including emerging economies with high growth potential. Diversifying internationally can reduce the risk associated with being concentrated in a single country's economy and provide opportunities for enhanced returns. Be aware of additional risks, such as currency fluctuations and geopolitical factors, when investing in international markets. Lastly, equal-weighted index funds. Traditional index funds are market cap-weighted, meaning, larger companies have a greater impact on the fund's performance. Equal-weighted index funds assign the same weight to each company, regardless of size, providing greater exposure to smaller companies within the index. This approach can lead to higher returns during periods when smaller companies outperform. This may also result in increased volatility. Consider your risk tolerance and investment objectives when deciding between market cap-weighted and equal-weighted index funds. So, what have we learned today? Index funds are a powerful investment tool. They offer low costs, broad diversification, and solid long-term performance. But like any investment, they come with risks, and it's important to stay informed and make decisions based on your financial goals. Before we go, it is very important to carry out due diligence. And remember to always consult with a financial professional before making any investment decisions. And if you've enjoyed this video, don't forget to like, subscribe, and hit that notification bell to stay updated with more insightful content from the Business Investment Vault. Your support helps us bring you valuable information week after week. Thanks for watching, and I'll see you in the next video where we shall be looking at major differences between Fidelity, Vanguard, and Charles Schwab. Keep investing smart and stay financially empowered.